I'm John Hanna for CDTV.net in New York, and we have David Wyss, Chief Economist for Standard & Poor's, joining us today. Thanks, David.
Thank you.
David, we're gonna try and figure out what's going on with the market right now because of there's been a lot of issues out there. It's kind of more concerning towards the direction of the market within this year or even next year. Currently, the hot topic right now is the job growth and job cuts. What are your thoughts about it?
Well, I think what we're seeing is a half-speed recovery. The good news is that the numbers have plus signs in front of it. The bad news is the numbers are really small. There's just a lot of headwinds here, and as a result, we're making very slow progress in recovering the employment losses, reducing the unemployment rate, or seeing any meaningful growth in the economy.
And on top of that, I've seen for the past couple of days now that there's been a lot of job cuts now with some of the major companies.
We've had a lot of job cuts. On the other hand, you've also seen some major hiring going on, so there is a bit of a mix. We do have some short-term problems, particularly in autos and electronics, because of supply chain problems as a result of the Japanese earthquake and tsunami. That'll probably take a couple of months to work its way out.
There's inflation. I mean, we got the price of oil, and then we have the price of commodities, and and everything is going up. And on top of that, it goes on to it's being tacked onto the consumer now, food-wise, and whatever products that people are buying right now.
I'm not as worried about that as a lot of people are, because what we're seeing is fairly limited to commodities, and particularly to energy and food, where you've got different stories. On the energy side, obviously the Middle East issues caused a spike in oil prices. Actually, the spike was even bigger in Europe than in the United States because of worries about supply disruption. That seems to be moderating. Prices have come back down to around $100, which is still high, but not a lot different than they were a couple of months ago. On the food side, we've had a succession of bad harvests, particularly in Asia, but Europe, which have shoved food prices up, combined with the bad winter weather that we had, which hurt fruit and vegetable prices over the winter. I think, I'm hoping the weather gets back to normal. If it doesn't, we may have bigger problems.
Now, the next thing that I wanted to talk to you about, since you've touched on already the Middle East issues, what do you think that's going to happen now? How is that going to play out? I mean, there's going to be people protesting on the street and all that stuff. What's your take on that?
Got me. To be blunt, I don't know what's going to happen here because we're just in uncharted territory on the Middle East. We always see this turmoil in the Middle East. It's characteristic. This seems to at least have some positive elements to it that maybe we'll see a movement towards more open, more, dare I use the word, democratic governments over there. On the other hand, there's always a risk that revolutions get hijacked by the extremes, and you could end up with increased Islamist influence over there as well. So this could go either way at this point, but in the short run, it is a disruption in the world marketplace.
With all this turmoil happening on the Middle East and inflation, some inflation worries, and growth, what do you think is the next emerging market out there?
Well, there's a lot of emerging markets that are doing very well right now. Latin America, Africa, Middle East, when they're not having wars, are doing quite well right now because those are basically commodity exporters, and strong commodity prices are good if you're living in Latin America because that's your main export category. On the other hand, in Asia, you've seen growth despite the high commodity prices. They're commodity importers, but a combination of financial markets that didn't freeze up like the developed financial markets did, and some very proactive government policies over there have kept growth quite strong. So that growth is continuing. So I think we're continuing to see this strong growth in Asia, somewhat offsetting or somewhat boosting, hopefully, growth in the developed world. In terms of the next markets, obviously everybody's been talking about the BRICS for a long time. The new question is sort of the next tier of markets coming along in the wake of the BRICS, generally smaller, but places like Indonesia, Vietnam, South Africa, Turkey. There's obviously more risk there, but risk tends to go with reward.
Um, let's talk about currency now. On the currency wise, which one do you think has more weight?
I don't know right now which currency is going to be strong. I certainly would expect the Chinese yuan to continue to rise relative to the dollar and probably relative to the euro as well, given the balance of payments surplus and heavy investing being done. Dollar versus euro right now, though, I would vote in favor of the euro. I think it'll do a little bit better, but obviously they're facing some big risks down in southern Europe, and there are people who are worried that when those 10-year euro bonds mature, there may not be a euro around anymore. So there is some risk there. My personal feeling is the euro will survive. I'm not sure that all the member states will be in the euro in 10 years. And then for Japan, obviously the yen was extremely strong. But then with the problems that you've got in Japan, that is actually giving an extra boost to the yen because the assumption is the Japanese government's going to have to borrow. The yen may be a little bit too high in the near term right now, and I wouldn't be surprised if it starts to come down when the economy recovers a bit.
The next one that I wanted to cover is that the euro members right now, the Greece issue, Portugal issue, members of the euro nation. What happens if they default? What happens with their economy, and whether or not, like you said, if it's still going to be the same euro nation members 10 years from now?
Well, Greece has a big problem. Debt is at a level that's very hard to sustain. They need some help, and that help is either going to come from, well, it has to come from some form of debt reduction, whether this is a default, a voluntary restructuring, a bailout by the ECB. Something is going to have to happen there. The worry is that if it doesn't, and this goes to an outright default, then the pressure is going to come even more on countries like Ireland and Portugal, and you could see the dominoes falling through southern Europe. At some point, that threatens the euro itself. It threatens the banks in Germany and France who hold a lot of this debt, and threatens the stability of the world financial system. There's a risk you could see a lockup like you did in late 2008.
Talking about debt, let's focus more locally here in the U.S. We got the trade deficit. We've got the federal debt as well. What are your thoughts first on the trade deficit?
Well, the deficits are unsustainable, both the trade and the federal deficit. On the trade deficit side, things have improved. The deficit's about two-thirds what it was at the peak back in 2006, but it's still too high. A falling dollar is helping. That's making it easier to sell our goods overseas, but one of the problems we have is our biggest markets, which are the other developed countries, just aren't growing. So even if our prices are better, if the guy's not buying, there's not a lot you can sell. I think that's going to continue to be a problem for the United States. The other issue connected with that, you're seeing the Chinese government particularly deliberately maintaining a balance of payment surplus, the Japanese as well, by trying to hold their currencies down. Japan seems to have hit a failure on that as a result of the crisis, but China is certainly continuing to do it. You also have very strong surpluses from the OPEC countries as a result of the high oil prices. You add up the surpluses of the oil producers, China, Japan. Last year is looking at close to $1 trillion worth of trade surpluses. Well, given arithmetic, somebody's got to have $1 trillion worth of trade deficits. And that's going to make it very hard for the U.S. to get back to balance.
So what happens now with the U.S. with that mounting debt?
Well, the U.S. has the advantage in terms of the government debt that the debt is all in our own currency. And therefore, that does give you more room because there's very seldom a good reason to default because it's cheaper to print more money than to default. That doesn't mean outside investors are going to like it, and it's going to be more difficult and more expensive to borrow from overseas as a result of that. If we don't get our debt under control, if we don't get that deficit under control, we're going to hit a wall in a few years. The blunt fact is, right now, U.S. government debt's about 65% of GDP, which is within the range of other AAA countries and certainly a sustainable level. But the problem is we're borrowing 10% a year. In Reinhardt and Rogoff's book, This Time is Different, they say that their study of 800 years of history suggests that when government debt hits 90% of GDP, you have a financial crisis. Well, if you're at 65% and you're borrowing 10% a year, how long is it before we get to that cliff at 90%?
Right. Wow. Next year's election. Which do you think is going to happen? It's going to be more on the Republican side or more on the Democratic side?
I don't know. It just depends on the result of the next election. I think you need some kind of a combination of spending cuts and tax increases, because I don't think you can do it all with spending cuts. Not unless you're willing to make much more drastic reductions in entitlement programs than I think Congress is willing to make. You've seen the backlash on the Medicare proposal. Reducing. Problem with entitlement programs is people feel entitled to them, and they're going to take it very badly if you reduce their Medicare, if you reduce their Social Security, and without doing that, there's just no way to balance the budget unless you're willing to have significant tax hikes.
And on our last note here for today, today's your last day for Standard & Poor's, right?
Actually, tomorrow, but yeah.
Okay, tomorrow is going to be your last day of the Standard & Poor's.
Right.
We want to be able to continue to talk to you. What are your plans?
I'm actually going to be teaching up at Brown University in the fall.
Nice.
On a half-time basis. And one of the courses is actually going to be a course on globalization and the rise of Asia. So I think it'll be interesting. It'll be a nice change. And I want to slow down a little bit. I don't want to stop. I just want to slow down a little bit.
There you go. Best of luck on the new endeavor. And definitely, we would like to pick up the phone and give you a call one of these days and continue talking to you about the economy. And especially now, you're going to be focusing more on the Asian markets.
Right.
It's going to be I think it's going to be an awesome thing to do as well.
I think it'll be fun. Actually, I just got back from Asia a month ago, so.
Oh, okay. Well, now that you mentioned that, what's your take now? Where did you go and what's your take?
Well, I was in China for 3 weeks, and it's the first time I've gotten outside of the big cities, so that was sort of nice. I took some vacation time and spent a couple of weeks outside of, out on the Yangtze River basically most of the time, out in Guilin and Chongqing and those places. And, you forget there's a lot of China that's not Beijing and Shanghai. And it's poorer, but it's coming up quick. There's a lot of room to grow. And I think China's got a lot of room to grow. I think it's still going to have the fastest growth rate in the world for probably another 20 years or so before some of the problems become too severe. That doesn't mean it's going to be straight line up from here. There are some problems. I do think there are some property bubbles going on. Quality of construction, quality of maintenance is a problem. But at the same time, boy, every time I go over there, the skyline changes. It's just amazing how fast things are changing there.
And how are the people? Are they buying stuff? Or do you see them walking around in shopping bags, or?
Yeah, the consumer culture is alive and well in China, but at the same time, you have to realize there's no retirement plan. With the one-child policy, they can't rely on their kids to take care of them. People are saving more. You're looking at a personal saving rate, a household saving rate around 25% in China because they know they've got to do that if they're going to prepare for their retirement. So it's not quite as consumer as the U.S., but at the same time, people are buying cars. The Chinese government has restricted car sales in the big cities, as a matter of fact, because of congestion problems. If you want to buy a car in Beijing, you've got to apply to a lottery at the beginning of the year, and they only issue 250,000 new license plates a year. So there are some serious issues. I think one reason you've got the property bubble is because people are trying to save this money, and that's one of the few things you can really invest in China right now is residential property. All of that stuff, the imbalances are going to have to be fixed eventually, but there's so much growth out there that with that that much momentum, I think they can drive through a lot of these imbalances.
And I would like to visit China one of these days just to see what's out there and the economy and all that stuff. Well, like I said, good luck to you, sir, and keep in touch. We're definitely going to follow up on you, sir, on the different aspects with regards to the Asian and as well as the global economy. You've been a great uh, contributor to CDTV.net. Thank you, sir.
Thank you, John.
Bye. That's David Wyss, Chief Economist for Standard & Poor's, and I'm John Hanna for CDTV.net in New York.